Today, we are talking about a great mortgage option for self-employed borrowers. No tax returns required. So, what we're going to be talking about something is called non-QM mortgages. A non-QM mortgage is not your traditional mortgage, right? Meaning it's not FHA, it's not VA, conventional, or USDA. It is a mortgage that requires a higher down payment. It also typically has a higher credit score requirement, as well as it has a higher interest rate. The caveat to that is it has less documentation required, right? So let me give you an example of a non-QM mortgage, a bank statement loan. So what a bank statement loan is, it is where we will take, and this is for business owners, right? The bank statement loans are for business owners. We will take either 12 or 24 months of your bank statements. We will look at the income deposits that are coming in on your bank statements. And what we will do is we will calculate them. And by calculating those deposits, we will look at it and give you a qualifying income. And it's the same as traditional financing. We look at how much money does the borrower bring in on a monthly basis that we can give them an average on, and how much do they have going out. And then that will allow for us to come up with debt to income ratio and how we qualify. Great part about bank statement loan is no tax returns are required. We need either 12 or 24 months of bank statements. Now, and the good part is it can be either 12 or 24 months of personal bank statements. Example, if you're a business owner and you deposit your income into a personal bank, then that's fine. We can get those bank statements. If they are in a business bank account, we can also utilize those. If there is a combination, because when you first started your business, your deposits were in your name and they were going into the bank, then we can utilize those even once you transition to your bank statement, your business bank statements. Requirements also are is that you have owned or ran a business for 2 years. What we do is we get a questionnaire filled out from you as the borrower, and we find out how long you've been in business, and we do some due diligence. Even though tax returns are not required, if we can get a letter from your CPA saying that you've been in business for 2 years, then that is sufficient. If let's say you didn't do your tax returns, if we can get a letter, well, not a letter, we can get something from the Secretary of State showing when your business was started, and maybe something when your business bank account started. Those are things that we can utilize to verify that you've been in business for 2 years. Let me be clear. 2 years means if you started in January of 2021, January 1st of 2021 to January the 1st of 2023, that's considered 2 years. If you started in March of 2020, well, let's say January of 2021, and let's say the date at the time was uh, January of 2023, then that doesn't work. So let's say it was January 1st, it has to be a full 2 years. Let's say it was January the 2nd of 2021 when you started, and it's now January the 1st of 2023. That's not a full 2 years. So we can't close before you've been in business for a full 2 years. Hopefully that made sense. So bank statement loans are non-qualifying mortgage, just meaning they are typically underwritten differently. They require a higher credit score. They require a larger down payment than typical financing, as well as they also require typically have a higher interest rate. So on the bank statement loans, while the interest rate is higher, there's no mortgage insurance. So in some instances, the higher interest rate with no mortgage insurance kind of evens out. So like on FHA, FHA and conventional financing and USDA, there is a mortgage insurance requirement if you put down less than 20%. In this case, on a bank statement loan, if you put down 10%, you still don't have mortgage insurance. The lowest down payment for a bank statement loan is 10%, but that's also based off your score. So the minimum credit score for a bank statement loan is a 640. So if you have a 640 credit score, your down payment is going to be 20%. It's going to be 20% of the sales price. So if you have a $200,000 loan, 20% of that is $40,000. That also means you have to bring down, that's just your down payment. You also have your closing costs as well. So bank statement loans is one of the most common non-QM loans that are used for homeowners to buy, for potential homeowners to buy or business owners to buy a home because they don't want to use their tax returns because they don't show enough income on their tax returns. They may not have done their tax returns, or they just want to use that in place of your tax returns. So that's bank statement loans is one. Another loan we have is a profit and loss statement. Some people are 1099, and again, they're in a situation where they don't have what they need on their tax returns, or they haven't done their tax returns, and they don't want to utilize that. So we can, if you're 1099 and you have a certified public accountant provide you with a profit and loss statement, then we can use the income that they give you on the profit and loss statement. It has to be a CPA. Can't be a normal tax preparer. It has to be someone who's certified to do it, to give you a profit and loss statement. The profit and loss statement will allow for you to qualify. You don't need your bank statements. You can have a 660 credit score, and we can go up to a 90% loan to value, which means the higher your credit score, the less you have to put down. At a 660 credit score, you're looking to put down 20%, 680, 15, and a 700 or better, you're looking at putting a 10% down payment. Again, interest rate's going to be slightly higher on a profit and loss statement loan. Of course, your down payment is more than traditional FHA, but in some cases, you have to put 10% down on conventional financing in order to make the deal work. So it just depends. It's, the better the score, the lower your down payment. The minimum down payment, no matter what your score is, 10%. Again, there is no mortgage insurance on the profit and loss statement loan. We can loan up to $2 million on the profit and loss statement loan. Again, this is for people who are 1099. Example, truck drivers. I've had some physicians who, instead of being a W-2 with the hospital, they're a 1099 employee. And we can do it with either 1 or 2 years of 1099s. It just depends on how you want to structure it, or which shows a better income. Now, the profit and loss statement loans is good for if you're owner occupied, if it's a second home, or if you're non-owner occupied. So let's say, example, for non-owner occupied, you are living in New York and your wife wants to move to, you guys decide you want to move to, let's say, Georgia. If you're not going to occupy it and your wife is, then you can be a non-occupied co-borrower until you move there. That works great. So we can still use your income and your debts, and then whoever's moving, whether it's your wife or if it's even one of your kids going to college and you want to purchase a home, we can use the profit and loss statement loan to help you qualify for a house. It is good for a purchase. It is also good for cash out or rate and term refinance. So this program gives you an option to do investment property, non-occupant co-borrower if you're going to live in the property. And let me say that again. It is up to 3 million, not 2 million. So we can do it up to 3 million. And there's a minimum loan requirement of $150,000. The other benefit is, if you're 2 years out of foreclosure, short sale, bankruptcy, or deed in lieu, you can participate in that program. Again, you may need 20% down and a 660 credit score. However, it does allow for you to purchase a home without your tax returns. If you're just joining my live, I am speaking on non-QM loans. We've discussed bank statement loans so far, and we've also discussed profit and loss statements. If you are a I-10, meaning you have a tax ID number here in the United States, because you're not yet a citizen, then we have a program for you as well. We can do an I-10 loan, which will allow for us to let you become a homeowner. It is for your primary home only. We can do up to $2.5 million. There is a minimum loan requirement of $125,000. If you had a foreclosure previously, a short sale, a deed in lieu, then that's a 1 year seasoning. If you had bankruptcy, then it's a 2 year wait. Now the I-10 loan is good if you're purchasing or if you're doing a rate and term or cash out refinance. Again, this is for individuals who do not have a social security number in the United States, but the borrowers with an I-10 number can qualify for a mortgage. You have to meet the eligible guidelines. The product is a full document, so we need pay stubs, bank statements, W-2s or 1099s, as well as tax returns. But it does offer flexibility for individuals who may reside outside the United States or who don't have a United States, so who don't have a social security number in the United States. So this is another great option. So far we've discussed for primary residence, and a few of the loans have been for investment, so you can do cash out refinance loans. Now, if you are an investor and you are self-employed and you do not have tax returns or do not want to use tax returns, we have a program called Investor Cash Flow. You may see it online as a DSCR, which stands for Debt Service Coverage Ratio Loan. Basically, what it does is allows a client to qualify based on the rental analysis to determine the cash flow of the property. There's no personal income required. This saves you from submitting income statements, tax returns. What the debt service ratio is, it just want to make sure that does the property cash flow based off of current market rents. If there's already a lease in place, then we look at that as well. It can be in a LLC. So let's say you want to close a property in an LLC, we can do that. If you already have a property that you're looking to do a cash out refinance or rate and term refinance, it can also be in a LLC. We can do up to $2 million. So the loan can be up to $2 million. Also, the minimum loan amount is $75,000. Minimum credit scores is 680, and we can loan up to 80% of the loan to value, which means your investment is a 20% down payment. DSCR loans are used for people who have either purchased an investment property in a hard money lender situation. So they're going to either cash out refinance or rate and term refinance out of that loan, so they can get something that's fixed. Typically, hard money loans are interest only and for a specific period of time, anywhere from 6 to 12 months, right? Um, Another key with the DSCR, the borrower has to own a primary residence. They must own their primary residence for at least 2 years. So let's say that I was doing a loan and I live at my current residence for 12 months, but previously I lived at a different address and I owned it as well, then we can still use that as 2 years. If I've lived in my property that I'm currently in for 2 years, I'm fine. We just have to show that the borrower has lived in or owned their property that they live in, a primary residence, for 2 years. The DSCR loans are also used for investors who have over 10 loans with either Fannie Mae or Freddie Mac. So with conventional financing, there's a max of 10 loans that they will allow for you to have. If that is the case, you can do a DSCR loan to purchase a property. So this is a way for investors to be able to get more investment properties. Again, it can be in an LLC if you already own it, or it can be in your primary name. It's just up to you. Now, with the DSCR loan, it is 30-year fixed, but we also have 30-year interest only loans available. It just depends. So again, guys, we are discussing non-QM loans, which are non-qualifying mortgages. Non-qualifying mortgages are different than your traditional loans of FHA, VA, USDA, um, conventional and conventional loans, and construction and perm loans, right? So you want to make sure that if you are a business owner, and this is great for business owners, if you are a business owner and you make and you're looking to purchase a home, you may want to talk to your lender to see if one of these programs you fit in. As a lender, when I pre-approve a borrower, I take a look at their paperwork, and we look at the traditional route first. If we don't go or we don't qualify for the traditional route, then we will take a look at the non-qualifying mortgage options and go over what scenario fits you best based off what you're looking to do. If you are new to this channel, do me a huge favor and hit the subscribe button. You'll be notified every time I go online. If you have any questions pertaining to non-qualifying mortgages, type it in the chat. We're here in the comments. We're here. I'm here to answer those questions. And if you're listening to the replay and you have questions pertaining to non-qualifying mortgages, you can tap in below. Put your comments in, and I do go back and read and answer the comments. If you would like to discuss it further, you listened to the live and you watched it and you think you may be a candidate for one of these programs, you can contact me at Team Jefferson at summitfunding.net. The link will be below. You can also schedule an appointment with me using my Calendly link. And you'll be on my calendar and we will grab a Zoom call to go over your options as to what you can qualify for or how these particular programs could work for you. The other thing is, guys, I have a first-time home buyers guide, a guide to take you from A to Z to help you with qualifying for a mortgage. The link will be below, and that will also subscribe you to my weekly newsletter that we send out information on how to different topics on how to purchase a home, things you should do or shouldn't do before you start the home buying process. So the links are below to join my Facebook group as well. We have a Facebook group where we post in, we interact, and sometimes I'll go live or we'll be going live in the Facebook group as separate from this group. So joining my Facebook group, it also allows for you to have access to me, to ask any questions or see what's going on where I make posts in the group. So the link is below to join that. Again, if you're just joining the live, we are talking about non-QM loans, which are non-qualifying mortgages, different than your traditional mortgage, a great mortgage for someone who is self-employed, who may be looking to purchase a home, but they don't qualify for or qualify for enough for the traditional FHA, USDA, VA loans, or construction to perm. We've discussed the bank statement loans, which has a minimum credit score requirement of 640. We've got the profit and loss or P&L statement loan for 1 or 2 years. So you can either use, 2022 or 2021 profit and loss statements. Minimum credit score is a 660. If you don't have a social security number in the United States and you have an I-10 number, then we also have a loan for you for primary residences of minimum credit score of a 660. And then for our investor friends who are looking to purchase more properties, get them in their LLC or refinance out of a hard money loan, we have the debt service coverage ratio loan, also known as the investor cash flow, which has a minimal credit score of 680 and a 20% down payment. So with that being said, guys, if you have any questions, type them in the chat. You can leave them in the comments. I do follow up. I will take a look at my comments to see see what questions you have. I check them multiple times a day, and sometimes I check them every day of the week. So if you have comments, I will respond. If you have a question that may take a little bit more time, then you definitely can reach out to me on the Calendly link, or you can send an email to teamjefferson@summitfunding.com. I am with Summit Funding. I am with Summit Funding. That's the name of my company. I can help you in 46 states. My team and I can help you with you in 46 states, along with the non-QM products. We also can help you with the traditional FHA, VA, USDA, and conventional loans. Our FHA loans, we can do as low as a 500 with 10% down. 3.5% down requirement is a 580. Conventional loans, we can do as low as a 620. Honestly, they prefer you to have a 660, 680 credit score. With the VA, we can go as low as 580. And with USDA, we have a 620, 640 minimum credit score requirement. So we can help you with any of those loans as well. Again, if you are watching and you have questions pertaining to mortgages, I will answer those as well. It doesn't necessarily just have to be about the DSCR loans. I'm sorry about that. I froze. So guys, I also have a home buying journal. Now, my home buying journal is different than the home buyer's guide. The home buying journal is a journal. It's 90 pages of note taking, question asking for you that can help you guide you from when you meet with your realtor all the way until you close on your home. And there's also pages that you can notate things after you close on your home. The link for that product will be below as well. I actually don't have my copy with me to show you, but the home buying journal is for you to be able to journal your whole entire process from A to Z to qualify for a mortgage. And here it is. There it is. The home buyer's journal, the link will be below. There is a softback version as well as a hardback version. One is $29.99. One is $19.99. I think it is a great investment to keep you straight from taking notes. So when you have your buyer's consultation with your agent, you can take notes there. When you have a conversation with your lender, or me, preferably me as your lender, you can take notes there. You can take notes if you need to improve on your credit. There's places in there to take notes to improve on your credit. There's spaces in there to notate about each house you take a look at, what you want to take a look at in terms of your house. There's also notes in there where you can, there's also space in there where you can take notes about your budget. So it's a comprehensive book from A to Z, all things pertaining to purchasing a house, to getting to the point of purchasing a house, to after purchasing a house. There's a section in there where you can notate about your HOA, the numbers to your HOA, your appliances, when they were repaired, when they were replaced. So it's a comprehensive book that journals your entire journey through home ownership. If it's good for if something happens to you and somebody in your family needs to know something about the house, that information is readily handy. If you want to pass that information along to someone who buys your house after you sell, that is available as well. Questions: do you offer underwriting for pre-approvals? Full underwriting for pre-approval. Guarantee rate does this, I believe. I like this. So yes, we can do a TBD, to be determined. So what that is we process and underwrite your credit and your employment all the way through. And then when you get finished, you have what's called a conditional approval, meaning your credit's been approved, your income's been approved, your assets have been approved. All we have to do is wait for you to find a property. Once it goes on, you go under contract and we do the appraisal. This will help speed up your process. So instead of a 30-day close, we're looking at potentially 15 days. Sometimes it can go faster. The only reason why we do not can't go faster is if the appraisal has not been done. One of my teammates should have reached out to you. If they have not, and I'll check tomorrow, I'll reach back out to you to give you feedback. Thanks for following up with me as well. Again, you said we'll hear about you for a month. That'd be great. I look forward to it. And thanks for your question. What state are you in? Oh, and just to let you know, if we aren't available or my team and I are not licensed in a state that you are in and you need a referral, I can refer you to someone in that state. We don't lend in New York. We're currently working on that. We don't lend in Massachusetts, Rhode Island, and South Dakota. Those are the 4 states we aren't able to lend in. Yep, we do have a team in Illinois. So when you are ready for the new construction, VA new construction loan, just reach out to me at Team Jefferson at summitfunding.net, as well as, or you can schedule a calendar link so we can discuss it in further detail. I look forward to speaking to you and your family as well. Again, if you're just joining us live, we're talking about non-qualifying mortgages. They're not your traditional mortgage. These loans are great for investors. They're also great for self-employed borrowers. And the bonus to this is on none of these non-QM loans, except for the I-10, do we need tax returns. The I-10 is where you're buying primary residence and you don't have a social security number in the United States. However, you do have a tax ID number and you'd like to become a homeowner. We will then underwrite your file and see what you qualify for. Again, the I-10 loan is 25% down payment requirement, 660 credit score, but it's great for someone looking to purchase. The additional non-QM loans that we discussed, bank statement loan, profit and loss statement loan, DSCR loan, those are three of the major loans. Anywhere from a 640, 660, 680 credit score on a bank statement loan, the minimum down payment. If you have a 700 credit score is 10%, 640, you're looking at 20 to 25% down. On the CPA loan, you're looking at 20% down. And if you have a 700 credit score, then you can do 10% down. In terms of the non-QM loans, they're great for business owners who don't have tax returns or don't show enough income on their tax returns. They can still qualify for a house. I still tell people that the biggest difference is you're going to have a higher interest rate because you're providing less documentation. So if you want more, if you want to try to get a lower interest rate, you do have the ability to buy it down. However, if not, then you can try to go the traditional route with FHA, VA, USDA, or conventional financing. If your taxes aren't in a position where it allows for you to qualify and you do make money or have money, then you can do the non-QM loans and you can refinance. So that's the other thing. I've had clients who have done non-QM loans, and then in a year or two, once they had their taxes where they needed them to be, they went back and refinanced so they could have a 30-year fix with a lower interest rate. I will say that as of now, during this time, and I'm not a tax, so please speak to your tax consultant. A benefit of potentially doing the debt service ratio coverage loan or one of these non-QM loans is that you get to write off the interest. You can do it on a traditional loan as well, but you have another write-off in terms of the interest that you pay and the taxes that you pay on home ownership. So, it's another benefit to home ownership as well. Most of these loans, actually none of them have mortgage insurance. So that's why the interest rate is a little higher than normal, because you don't have a mortgage insurance. I recommend getting pre-approved first and then getting the realtor, because the realtor is not going to show you a property unless you have a pre-approval. A builder may let you go in and look at a property, but if you're getting a new build, you don't know what price range to look in. You may be looking under your price range. You may be looking over your price range. So my opinion, get the loan officer first, get the pre-approval, and then get with a realtor. If you need a realtor, I can refer you to one in that area once we have you pre-approved. That's a great question. Again, guys, we are talking about non-QM loans. We're talking about the benefit of a non-QM loan, which a non-QM, if you're just joining live, is non-qualifying mortgage. It is a mortgage that's different than FHA, VA, USDA conventional loan. It offers some great benefits, for people who have better credit scores or people who have money to put down. There's a way for you to qualify for a mortgage that's non-traditional. A lot of people who don't have their bank statements, but you have to be self-employed, except for the DSCR loan. No, you're fine. You're fine. That's fine. The questions are fine. We're here for these questions. Except for the DSCR loan, you just have to. The DSCR loan is the only one that can't be a primary residence. The DSCR loan has to be for an investment property, whether you own it, you're looking to purchase one, cash out refinance, or rate and term refinance. If you're new to my channel, do me a huge favor, hit the notification button, subscribe button so you can be notified when I go live. Also, if you'd like to join my Facebook group, a part of my newsletter, or purchased a home buyer's guide, the information will be down. I mean, the home buyer's journal information will be down. When shopping, how many applications max and within what time frame? I've heard different thoughts. So you can go to 3 different lenders if you want. I mean, it's totally up to you. Within a 30 to 45 day window, you shouldn't see a difference. Now, I know on Credit Karma, I think it tells you 14 days, that you have 14 days to shop, which is not true. If you go to the CFPB's website, it will tell you have 45 days. Now, each lender you go to will be a hard inquiry. They will show up as a hard inquiry, right? So if you go to 4 mortgage companies, you're going to have 4 hard inquiries. In that 45-day period of time, that first lender who pulls your credit, it will ding your credit in terms of score wise. And that's anywhere between 0 and 5 points, right? So between 0 to 5 points, your score will drop. You won't necessarily know what the 0 to 5 points is, because if you don't know your mortgage score, right? So the only way to really find your mortgage score is through my FICO or through a mortgage lender. Sometimes I have clients who say, hey, my score dropped on Credit Karma 15 points. That's not your FICO score. That's a Vantage score or Credit Sesame. Those are your Vantage scores. What you do need, though, is to make sure that you are prepared if you're going to shop around, that you're prepared to be able to get the lenders what they need so you can make a decision on what you need in the process. You want to make sure that you apply with lenders to who you're going to help. So example, I say that for this reason. There's a reason why there's a ton of different lenders. Each company has a different requirement for what they look for. There's different things that lenders do or don't do. I know some lenders who don't have the new construction permanent or one-time close programs. I know lenders who don't do FHA loans. I know companies who don't do VA loans. I know companies who don't do non-QM loans. They only do the traditional 4, right? You need to go to lenders who offer the service that you're looking for or what you need, right? And with that, you want to make sure that if a lender gives you an answer as to why you don't qualify, and you go to a different lender and they say they can do it, even if it's me, ask them how or why. What makes you different? I'll tell you why. I had a client who came to me. I looked at their information to pre-approve them. They did not qualify for as much as they wanted, nor did they have any money for closing costs at all. So in this market, even though sellers will pay some for closing costs, they're not going to pay all. They had no options to get additional closing costs. We could qualify them for a down payment, but again, you still need closing costs to close on a home. They went to a different lender who pre-approved them for like $45,000 more than I did. The lender had them approved for a down payment assistance program, but the seller wasn't paying any closing costs. But guess what? We found out the lender approved them for more because they utilized overtime that you could not count. So then the lender stopped responding to the borrower. They were under contract and they lost their earnest money. So I know, I'm not saying don't go to a different lender, but if you go to a different lender just because you want to hear what you want to hear, that may not be beneficial to you. So now this person who had no money to start with has less, and they took the word of the lender because the lender told them what they wanted to hear and not what they needed to hear. I mean, and we're talking about a matter of a month in difference where you haven't saved any money, you haven't got any more income. So you put yourself in a position where, okay, I can buy a house. I'm going to buy this house, but you're still in that same spot of I don't have any money. You got the down payment assistance, but you know you need closing costs and you don't have it like that. So those situations get people caught up. It's not that lenders, our job as lenders are to approve loans. That's our number one job, is to try to approve loans. If we can't approve a loan because a person doesn't qualify, that you should be told. So I always tell my clients, okay, we can't qualify you now, but this is what you need to do to qualify. Now, if you don't like the answer that I give you and go to a different lender, cool. But I always tell a client why they don't qualify for what they want or qualify and how they get there. And if a lender tells you something different, then I'm going to ask you to ask them, hey, tell me. Or if I tell you no and something different, and another lender tells you yes, come back to me and ask me, hey, Kevin, this is what they said. I thought you said, and I'll explain to you, because what I don't want to see is people lose their earnest money when we already are short funds. Or even if you're not short funds, I don't want anybody to lose money because the lender told them. And see, to me, it's relationship based. I'm going to be around. I'm going to answer your calls. I'm going to be at your housewarming if I'm in the area, if we're close by. I'm looking to build that relationship with you. If it's an online lender, you're just a number. Like you get a ton, they get a ton of leads, so it doesn't matter if they call Kevin Jefferson back, or it doesn't matter if they mess up on Kevin Jefferson's loan because they never have to talk to him again. Let's see, I think we got a couple more questions. Let me see. They always say shop around to compare best offers or better rates. So that's true. So what I've been seeing, Miss Johnson, is lenders giving low rates and low fees to lock you in, right? So say example, I quoted you a 7.5% interest rate. And let's say I said, hey, closing cost is going to be $15,000. And then another lender said, oh, I can do a 6.75 interest rate and closing costs will be $7,000. You're probably going to go at the lower interest rate and you're probably going to go with the lower closing cost amount. I can speak for Kevin Jefferson. I quote high because we don't know what the market is or the property is or what the taxes and insurance are until we get them, right? So I would rather tell you that you have to bring 15,000 and you need 12 than to tell you need 7 and you need 12. And what happens is a buyer will back out of a loan or potentially lose the deal because they don't have those additional funds, or they go out and spend those funds because somebody told them they needed less money, or they don't have access to a gift, or they can't get funds out of a 401k or some type of retirement fund. So there are lenders who lowball quotes, they lowball fees and interest rates to get you hooked in, because then they can say, oh, well, while we were in a deal, the market changed and now interest rates have increased. Now the closing costs have increased. I go over all that information and discuss it with you so you know why we price it the way we do. Again, guys, if you're just joining the live, we were talking about non-qualifying mortgages earlier. Go back, if you're listening to the replay, go back and listen to it from the beginning. You'll grab some great information. If you are looking for a consultation or you just have questions, the consultation is free. The questions are free. Reach out to me below with Team Jefferson, or you can book a call with me and get on my Calendly link so that we can discuss your options of home ownership. Also, if you're currently with another lender or having pre-approval and you would like to get a second, third, fourth opinion, reach out to me. There are no cost, second, third, fourth opinions. I can look at your credit. I can also look at your, or I can just look, if you want to, and you just want a second set of eyes for someone to look at a fee sheet the lender gave you, I do that as well. I will preference to you, I'm not going to do a whole bunch of additional research so that we can get the deal done for the other lender, but we will look and see if you're getting a fair deal or if it makes sense for you to apply with me because I could do something better. If you're watching this live and you have been turned down by another lender, call me, or a couple lenders, call me to see about getting an approval. If the other lender did not give you a game plan, reach out to me and my team. We will get you a game plan. All we ask is you to be loyal, meaning if we give you a game plan to get you in position to become a homeowner, we just ask you to utilize our services. Hopefully that's not too much to ask and that's not being too bold. But if we give you a game plan to get you on the path of home ownership and no one has told you, all we ask is for you to use our company and our services. Sometimes the rate is higher because we get paid for our skill level. I'm very good at what I do, very knowledgeable at what I do, very good at credit, very good at making things work. I have a deal that was turned down by another lender. I got the buyer pre-approved. Did I do anything special? Probably not. I just know my stuff. That's the key. I just know my guidelines and I know how to work numbers and I know how to make sure I know how to ask the questions to make sure a buyer has the ability to do a little bit more than they thought they had to. And sometimes on these loans, they sometimes on these loans, they have to do beyond, like for instance, this particular client, and she can't go conventional. They can't go conventional. And they've got to put 10% down on FHA. Yes, FHA's minimum requirement with a 580 score or better is a 580, but they don't qualify with the 580. They don't qualify with their score. So what we did was we structured the deal where she puts down a larger down payment. And what that does is it shows that, okay, it's less risk because instead of putting the minimum 3.5% down, they're putting down 10%. So that is one less risk factor. And she has some of her own funds. So there's different ways to get it done. Some lenders don't want to go the extra mile. Sometimes there's a manual underwrite, which takes additional work from us as from the lender standpoint, and a little bit more additional information from the borrower. But the goal is to make the deal work. Everything isn't going to be cookie cutter. Everything isn't going to be a square box fit into a square hole. Sometimes we've got to dig and figure out how we can make it work. Again, guys, thank you guys for the questions. Yes, no problem about the honesty. And listen, it's been times where I've seen people's information and what they got offered by a different lender. And I say, hey, it's no way I can beat that. There's just no way I can beat it. I get beat out, from time to time for lower interest rates, but I've also been beat out in the beginning and people come back to me because the lender didn't tell the buyer what they really needed or what what was really required. They just want to hurry up and get something done. Again, it just depends. Do I think the housing market prices will decrease? My answer is no. There's still a housing shortage. So let me answer that. Decreasing because people aren't buying houses? No. Decreasing because the seller and the realtor listed the housing price too high? Yes. Some people still want too much for their house that will not warrant the value. So when you're working with your realtor and you guys decide you want to put an offer in on a property, if the realtor doesn't already do it, ask them to run comps in the area to see if offering, let's say the house was $400,000, But you said, man, it seems awful high. And you want that house, ask the realtor to run comps to see if it appraised for 400,000. No, they're not an appraisal, and they don't know the exact science to it, but they can give you a good idea that, hey, yes, I think this house appraised for 400,000, or hey, I don't think it will. So it just all, it all depends. But just run comps, and have your realtor do some due diligence. Have your realtor do some due diligence on the property before you put the offer in, and then come to me and ask me, hey, can you give me a fee sheet on 123 Main Street so I can see what my down payment is, what my closing cost is. The goal is to make the buyer and seller happy. We also want to make sure we create solutions for the buyer to be able to purchase a home. And sometimes it is untraditional. So then you may not be able to go to FHA, USDA, VA conventional, right? You may have to use a non-QM loan. You may not be able to qualify with the score you have for a 3.5% down payment on FHA. You might have to put 5 down. You might got to put 10% down. You might qualify with 3.5%. However, because of your score and your debt to income ratio, they might ask you, hey, after you pay your down payment and closing costs, do you have 2 months or 3 months reserves available in case something happens? All of those are factors to help you get qualified. So yes, some people get in with 3.5% down. They use the down payment assistance program. The seller may pay some. They may not need to have reserves. However, everybody's deal is not the same. I've not done 2 deals that are the same ever in my life, even with the same person. I've done deals with one guy 3 or 4 times, and none of his deals were the same because it changes. His DTI changes. He increased income. He moved locations. One's a rental, one's not. So everybody's situation is different. Again, guys, I appreciate you jumping on with me. This has been awesome. Again, if you want to join my Facebook group, please join my Facebook group and my newsletter. The links are below. You'll get valuable information. I don't spam you. I don't sell your information. You can always unsubscribe at any time when you want in terms of the newsletter. You can always leave the Facebook group, but you'll get valuable information. You'll get to see, we're going to start doing more. We're seeing people who closed, having testimonials. Again, if you're watching this replay or you're just joining now, go back and listen to the beginning. We were talking about non-QM loans, which are specifically, most of them are specifically more than, for self-employed borrowers. Hold on, Miss Barbara. Okay. Miss Barbara, send me an email at teamjefferson@summitfunding.net. What state are you in? If you send the email to teamjefferson@summitfunding.net and tell me you want a pre-approval, or let's jump on a call. Let's jump on a call. We can talk, and then I'll email you specific instructions. I try to email specific instructions for each person based off of what they need. That way, I'm not sending you something or sending you an email that was information that doesn't pertain to you. Again, guys, Miss Barbara, schedule a call using the Calendly link here, or send me an email and we can set up a time to talk. Email me and let me know you're in Florida, and then let's jump on a call. The call typically takes anywhere from 5 to 10 minutes, and then I'll send you an email with specific instructions so you can get pre-approved. Again, guys, this has been great. I'm Kevin Jefferson, the People's Lender. Have a great night.